In this session, we'll be discussing asset class investing, which is a method of diversification that can improve your portfolio's performance and reduce risk by doing three things. First, it takes the guesswork out of investing. Second, it ensures you own the best performing areas of the market. And third, and most importantly, it smooths out the bumps in your portfolio's performance that might otherwise scare you into selling at the wrong time. Before we look at how asset class investing works, let's first define what's an asset class. There are two characteristics used to define equity asset classes. The first is the size of the company, and the second is the value of the company's stock price. For example, in terms of size, there are large companies in the market and there are also small companies in the market. By large companies, we're referring to their market capitalization, or market cap for short, which essentially measures the total market value of the company. Walmart, for example, is a large company. On the other hand, companies that have a smaller market capitalization are referred to as small cap companies. These tend to be companies that most people have never heard of. In addition to measuring companies by their size, you can also measure companies by a second characteristic, the value of their stock price. In this case, a company can either be a growth stock or a value stock. A growth stock has a higher stock price because the company has growing earnings and investors are willing to pay more for the stock. Whereas a value stock tends to have a lower stock price, meaning it's undervalued, which is why they're referred to as value companies. So essentially, any company you can think of will generally fall into one of these four boxes. There are large cap growth companies, large cap value companies, small cap growth companies, and small cap value companies, all of which are referred to as asset classes. These same asset classes also exist in international developed markets as well as emerging markets, meaning you can invest in international large caps, international small caps, as well as emerging market large caps and emerging market small caps. So how do asset classes help smooth out the ride for investors in order to capture steady market returns? The answer: these asset classes tend not to move in the same direction at the same time. So when one asset class in your portfolio is zigging, another may be zagging, thus balancing your portfolio's performance. That said, let's look at a chart of 8 major asset classes in the US, international, and emerging markets over the last 10 years ending December 2012. This chart ranks each asset class's annual performance from highest to lowest in each column year by year, with the best performer on top and the lowest performer at the bottom. Each asset class has been given a different color to emphasize an important point. In both the US and non-US markets, there is little predictability in asset class performance from one year to the next. You never know which asset class will outperform from year to year, and attempting to predict which one will be next year's winner is a guessing game. For example, there are cases where the best performing asset class in one year became the lowest performing asset class the next year, such as emerging market small cap in 2007, which in 2008 was the lowest performer. Conversely, there were years when